So just a few days ago, I was reading this book called The Barefoot Investor. Great book. And the author says you should never actually get a fixed rate mortgage. You should get a variable rate mortgage. Now, I always try to be objective here. And I always try to say, whenever I hear an idea that's different from what I usually have been told and what I usually practice and teach, I always try to stay centered and say, hey, I want to objectively see exactly what the author is saying here and why he's saying it without going automatically and saying, hey, variable rates are very crazy. They're very unpredictable. They even call it, for example, the 5 years and then you pray because you don't know what's going to happen next. During 2008, a lot of people's rates switched over and then a lot of people basically lost their homes. And by the way, in this video, I'll break down exactly what a variable rate is, what a fixed rate is, which one is best, and when can you actually use the variable rate. Because overall, it's not like, for example, this product makes no sense. It does make sense for a certain type of person. I'm going to share that, guys, with you guys in this video. So this way you have options. It's not good just to say it is never a good option to get a variable rate, because that's not true, because for some people out there, it could be. And that's why I'm making this video. And as always, guys, like this video on top. Also subscribe and hit the bell to get notified. And by the way, if you're asking, Tommy, which one did you get? Variable rate or fixed rate? The answer is I got neither. I bought my home for cash, which is absolutely one of the dumbest things you can do when it comes to finance, but it's what I did because that makes a lot of sense for my personal finance. And personal finance, or finance, is always personal, so you want to make sure you do what's best for you. And that's why I make these types of videos that might sound like fixed rate is the way to go always, but sometimes you could do something different that makes sense for your personal finances. So what exactly is a fixed rate mortgage? And by the way, guys, did you guys know that mortgage, the word mortgage in French basically means dead pledge? Like, it's like a bond until death, basically. And that's not what you obviously want, okay? But a fixed rate mortgage is exactly what it sounds like. You get a fixed rate for the lifetime of this loan. So whether you have, for example, a 3% loan and rates go down to 1%, obviously you can't take advantage of it. You cannot, unless you refinance. And if rates go, for example, from 3% to 20%, the answer is you're not going to be hit with that extra change, because in reality, you're fixed in, you're locked into whatever you had. That's the idea. It gives you protection, gives you stability. Sounds great, okay? That is exactly what a fixed rate mortgage basically is. But a variable rate is exactly what it sounds like. It varies, it can change, and they have different little contracts. So you can have, for example, the 5-to-1, 7-to-1, 10-to-1. Those are basically the most popular ones, but it basically means like for 5 years, you get a fixed rate. After that, the rate can change periodically. After that, you can have, for example, a 7-to-1, same thing, 7 years locked in. After that, it varies. 10 years locked in. After that, it varies. It all depends on exactly what you want. But the big benefit is basically that if you got a mortgage right now at 7% like there are right now, and the rates drop to like 3%, you can take advantage of that lower rate. And it's actually a lot more simple to actually switch from different lenders. There are benefits to actually doing this depending on the person and depending on your circumstances. But overall, who should go ahead? This is a very simple video, by the way. But overall, who should go ahead and get a fixed rate mortgage? In my personal opinion, okay, this is what I would personally lean towards. And that's because I know myself and I know my temperament, and I don't like to wake up guessing exactly what's going to happen. But it's not because in reality, when you get a fixed rate, you know the budget you make is exactly what it's going to be for the next 15 years or 30 years when you get this fixed rate mortgage. You know it's going to be 3%, or 5% or 7%, but you know that's exactly what it's going to be. And if you want to basically get out of it because rates change by so much, you can always refinance. But remember, refinancing isn't what it sounds like, in the sense that, hey, I'm just going to go ahead and repackage my loan, boom, let's say I save money. No, it costs money to refinance. It can be expensive. So you need to run the numbers and make sure it actually makes sense for you to be able to refinance and actually save as much money as you possibly think you're going to save. So the math needs to make sense. But overall, for someone that cares about stability in payments and doesn't want to worry about things changing dramatically, fixed rate mortgages are the way to go. For me personally, that would work best with my personality. However, though, number two, variable rates are not that crazy, and they're not that bad either, okay? But they work best for someone that has a good amount of equity in the home. Let's say like 20% and above, because this gives you a lot of possibilities in being able to have more power and switch over from one lender to the other lender because you have equity. And on top of that also, right, if you do have a strong amount of cash, or you include in your budget for these changes, you're actually able to not really worry about it as much. Because again, even though with variable rates you're going to change, you're basically going to save just a few decimal points or whatever, they do add up to tens of thousands of dollars once you spread them to 15 or 30 years. That's the big difference here. Now, for people that think, Tommy, but the big risk is that you have a 5-to-1 contract, 5 years you get a fixed rate. After that, all of a sudden, you have, for example, like this crazy hike. The answer is it's not like you're gonna go from 5 to 20%. It doesn't work like that, because these contracts have, for example, initial caps, periodical caps, and also lifetime caps. Meaning, these contracts are set up in a way where they can't go above a certain point. Okay, so it's not like you can go, for example, from 5% to 20%. Now you're paying going from $1,000 to 20,000. It's not like that. That's not really what's going to happen. But what you would do, if you're actually interested in it, is you take into account these potential changes, okay? And what the cap actually is. When I say cap, I mean, for example, the interest rate that it can possibly go up to, it is capped. So after that 5-year and that 1-year period, it is capped at a certain point. Periodically, it cannot exceed a certain point. For the lifetime of the loan, it cannot exceed a certain point. Now, obviously, this is a risk you're taking, and that's why you're being charged less money, right? But it also makes sense if you're going to be saving a lot of money, if you have cash to actually be able to withstand these kind of like turmoil periods whenever you have, for example, actual hikes or whatever. But it makes sense for someone that's either going to be moving out pretty soon, someone that has plans to pay off the mortgage as fast as possible, so they want to save as much money as possible, and they also adjust their budget for it. So overall, for me personally, I go fixed rate all the time. I recommend fixed rate all the time. But for someone that fits that personality or doesn't mind that stuff, and they can do the variable rates. But for me personally, it's not something that I would do. But it's not to say, when you run the numbers, okay, it's not to say variable rates don't make sense, because over time we do see mortgage rates are pretty stable, they go down, and things change, it can actually save you money. But what makes sense on paper, a lot of the times does not make sense in real life, in application. What I mean is, whenever you hear we have a market downfall by 50% every 10 years or whatever, but we always recover, that sounds great on paper. But when you experience that, that can basically have you selling all your stocks, okay? So it's like, I like to play a game that keeps me in the game the longest. So for me personally, this just would not make any sense. But I offer you these ideas so you can kind of like put them into your arsenal. And whenever somebody asks you, you're not just like ignorant about it. Some people tell you, hey, what's an ARM? It's an adjustable mortgage rate or whatever, right? So you actually, a variable rate. So you actually know exactly what everything is. You know the options, you know the pros, you know the cons. So you actually enter into a deal knowing more. You know what I mean? So it's good to know the other side before you say, I just do my side and that's basically it, because that's just ignorant. As always, guys, thanks for watching this video. I was confused. ARM is adjustable rate mortgage, right? Adjustable variable rate mortgage. But yeah, as always, guys, thanks for watching this video. Like, subscribe, hit the bell, shit notified, comment down below mortgage. And again, if you're going to be getting a mortgage, I highly recommend you get a fixed rate mortgage. On top of that, up here is my face. Click subscribe, and on top, I think the video is here. My face is here. I get confused sometimes. I'm sorry. I'm a human being. And as always, guys, thanks for watching. Peace.